Thank you, Nicholas, and Capital Link for, hosting this. And I hope people are, energized after the lunch break and the interesting discussions that have been had, and the panel we just had. So we've been through, most of the key segments, and right now I would like you to meet these guys in the product tanker space. So with us today we have from Premuda, CEO Marco Fiori. We have from Ardmore, Bart Kelleher, CFO. And we also have another CFO in Carlos Balestra di Mottola from D'Amico. And last but not the least, Bäcklund from Stena Bulk, General Manager in Products and Chemicals. So there's no certain topic for the product tanker space in terms of decarbonization and what people have been through in the past conferences that we've had. But I thought we would focus on three main parts in this panel, which is the market, the drivers, what is it that is keeping the product tankers, say, outperforming the VLCCs at the moment and having picked up sooner after COVID. We'll go through a bit on the financial side, obviously being here at Capital Link, and also going through the regulations and how that is impacting the decisions from these ship owners. So I'd like to start with the first question, and I think we could start maybe with Marco, if that's all right. So from a CEO perspective, with the product tanker market, which is performing considerably stronger this year and last compared with a weak 2021, what are the top market drivers supporting these solid freight markets? Is it owing to the demand side? Is it owing to the low delivery schedule, or hence a combination of both and the recent ton-mile changes? So what is your view supporting this strong product market that we're seeing today? Marco, please.
Me? Are you sure about that? Honestly, I've always been of the opinion that we're seeing a very strong market, but we would have seen a much better market anyhow. So it's not been the Ukraine war, the embargo with Russia. I think there was a lot of things that were already fermenting under the surface and would have been a good market. For sure, what I see on a very high level perspective is that, first, number one, there is less supply than used to be. If you see, on the product tanker market, I think probably there is 2 yards in Japan, 3 in Korea, and probably 2, 3 in China that are worthwhile. So you're talking about 3 to 5, 8 yards in the world that are producing coated ships, and there is very strong limits on how much can be produced. You talk with the shipyards in Japan, and this is not only for product tankers like Imabari or the big ones. They used to have big scheduled production of over 120 ships. Now probably they can produce 75. Why? They have problems with the staffing, COVID, supply, and all the supply of pieces of manufacturers that are getting done. So you see, really, there's been a huge change in the supply line of all the ships. So this, on the supply side, there is much less. On the demand side, I think with the fact of ton mile has been a big increase. The second big increase will be on the speed limitation for EXI and other carbon related. So I think you're having a double whammy effect. You have less supply and also demand that's growing due to ton mile increase. So I don't see why this market should be. Naturally, it's going to have some volatility, which is good. I think a market that goes just straight up is not good for anybody. And I think that's going with volatility is going to be a strong market in the future. We have been active in buying ships the last 2-3 years. And some owners said, we thought you were too aggressive, but in the end you were right. I think people who's been buying ships, I think they did very well. And I think especially modern ships, post 2013, the eco ships, I think you won't regret it. The only big change is going to be probably the next wave of ships that's going to be the more with new technology, dual fuel. Then you have to decide which dual fuel. But for the time being, people who are buying, who has bought eco ships, I think has been a good investment. I think because the ship price has totally moved. You had in the 90s, you had 20 to 28 million. Then you went from 29 to 35, 36, 29 in the year 2000. And remember, for my previous employer, we did a lot of those periods, which at around 30 was a great deal, very great price for MRs. And now you're moving in the 38 to 45. I don't think that there's going to be a lot of ships going back in the 35 million in the next years. I think it would be, especially with inflation that's been and everything, I think we have been moving of really a band of price band. So less supply and more demand for different factors. We always go back to that, you know.
Thank you, Marco. And the other panelists, do you share that view? And other than that, do any of you see any, short-term risks that could pose a threat to these, solid markets that we're seeing today?
Well, I think Marco was saying here, it's a combination of supply and demand. But even before the Russian invasion, we saw the ton miles were increasing quite a lot with the closures of refineries. For example, in Australia, we have seen that they've closed most of the refineries, and that has increased the ton miles a lot. Also in Europe, we have closed a few refineries, and that is increasing ton miles. So even before the invasion, we saw that ton miles were increasing. So it's strong fundamentals on the demand side.
Yes. Carlos?
Yeah, no, I agree with everything that was said so far. I would like to add that another important component on the demand side, another important driver is the very low inventories. I mean, we had a buildup in inventories actually throughout last year. If you look at refined product stock inventories only in OECD countries, they touched the bottom around March last year, and then they built up between April and December. In particular, in the last part of the year, there was an important buildup of stocks in Europe in anticipation of the sanctions that were going to come into force in February on Russian exports. That somehow dampened demand a bit in the beginning of this year. So we had an amazing year, but it would have been even stronger if we didn't have that buildup in stocks last year. They remained below 5-year averages, well below 5-year averages. Since then, they have been a bit more erratic, and more recently, these stocks have come down significantly. And what these buildup in particular in diesel stocks led to was, in conjunction with a slightly less vibrant industrial sector, in particular in Europe and in the US, was a decline in diesel refining margins, which were very high at the end of last year, but fell in the beginning of this year for most of the year. But most recently, they actually started moving up again, and they are now back at very interesting levels. So, and in the meantime, gasoline refining margins also increased, and fuel oil refining margins increased. So today, refineries again making very good money, and stocks have since fallen again. And given the OPEC cuts which have been implemented, they might continue falling still for a short while, but there's not much more they can fall. When refined product stocks reach such low levels in importing countries, it can create a very nervous market because at a certain point you just need to import. And then arbitrages open up. And especially in a high oil price environment, freight becomes a less important component of the equation. And therefore, who has to ship the oil can pay quite high freight rates. And that's what we saw at the end of last year. And there's a good chance we might see that again this year.
Thank you, Carlos. So I think we can conclude that product tankers, are seeing healthy demand and supply variables that are, destined to continue for the foreseeable future. Moving over to Bart. This could be a question, both for Ardmore, but also shipping in general. It doesn't have to be product tanker, but when you see these strong, market conditions and also a changing landscape, how do you, allocate capital as a product tanker company?
Sure, I agree. I think lots of capital allocation questions and decisions just across the shipping segments today. We take a multifaceted approach. We've had a capital allocation policy in place for a number of years before the increase in freight rates and TCEs. And so for us, we see it as a balance. We like to maintain, invest in the current fleet, and we see significant runway to make our current fleet more efficient. And as we take vessels through dry dock, for example, this year we have 8 dry dockings, and the routine dry docking CapEx is actually the smaller portion relative to other larger projects that we're doing in terms of investment in scrubbers, investment in micro boilers, and other energy efficiency devices that we see relatively short payback periods for and better investments than other opportunities. We'll continue to delever, and I think like our peers on the panel and across shipping, with the increase in rates, the ability to actually reduce the balance sheets and make them stronger and give you that dry powder for the future cycles. We're always considering growth opportunities. It's one that I think you have to have patience and be quite diligent. And today, certainly more of a challenge, but that doesn't mean that you don't stay in the market. And then also, but certainly by no means the end of our focus, return of capital to shareholders. And we think in such a market environment, it's obviously quite prudent to return capital to shareholders. So we reinstituted at the end of last year a dividend policy, and so we're paying a variable dividend, 1/3 of our adjusted earnings to shareholders. And in this market, that you have the luxury that's not a waterfall of capital allocation, but you can actually allocate across these different 4 pillars simultaneously is unique, and we think an important approach today.
Carlos and Marco and Ulf, anything you want to add to that in terms of your companies?
Yeah.
Carlos first.
Thanks. Yeah. Should I go? Let's go that way. Okay. Yeah. So yeah, we have been quite active as most of our peers. Deleveraging, that was our number 1 priority because, of course, we all have come from several bad years and where leverage built up in our balance sheet. At the end of 2018, the ratio between the net debt and fleet market value for us had reached 73%. As of 30th of June this year, it had come down to 25%. So we now feel this is at a very satisfactory level, and deleveraging, of course, is going to continue being important for us, but it's not the only main priority. I mean, we also are looking now to distribute more cash, also through share buybacks. Since a few months, we have been quite active in that respect. We were a slow starter there, but we have room to do quite a lot. We have an authorization to buy back up to 15% of the shares issued, and of course dividends. I mean, the dividend we paid, we approved out of the 22 results was not particularly spectacular given the results last year, but there's definitely room to do more, and we are looking forward to distributing an increasing portion of our profits, although we don't have an explicit dividend policy. And also we do have some opportunities for investments. We have a number of vessels which are in TC-in and which are in the money. They also benefit from quite low time charters, so we are not in a hurry to exercise these options. But we, given the outlook for the market, it's quite likely that we will exercise them at a certain point, and the outlay for exercising these options at the next possible date would be around $130 million, and we have $66 million in leases that can still be reimbursed, vessels that we have on bareboat, and where we can obtain significant savings by reimbursing them. All right.
Thank you.
Well, look, personally, I think, that high leverage, I think that actually the market turned around at the right moment. I think the whole tanker market, not only product, but also, I think was going through a difficult period. I think we would have had a very different conference if there was not this pickup in the market starting last year. And I think everybody involved, I think it's been tough years, but it's not only tough years, it's been constant tough years after tough year after tough year. So finally we had a turnaround, and that was good, that we expected. I think we agreed on the fact that the market would have changed with or without Ukraine or Russian sanctions. That I think has been more like an accelerant of the market. But the market was poised. For months we were seeing ton-mile getting longer, but why the market is not going up, ton-mile getting longer, stretch, why the market is not going up. So I think everything was in the making. Now what we should do, now investing today, it's very tough because the prices are very high. I think that probably, but on the other hand, you also have to reinvest because you're a shipping company, your assets are mainly ships, so something has to be done. I think that also against, we have a series of new ships, but I think the old is probably the one that's more targeted to be sold, because I feel that there's going to be regulation that are very adverse winds against these kind of ships, from a regulatory point of view of consumption, CO2, more expensive to manage. So I think the older ships, but I think everybody has been doing this choice. I think the D'Amico's done it, we have done it, I think everybody's been done. So it's kind of a no-brainer. And then starting to invest slowly into more modern ships. The only question mark is what kind of ships? Are you going to do them dual ready, dual methanol, dual ammonia? But I think this time will tell, But however, sorry if I'm not very politically correct, I believe that oil will be with us for a kind of a long time. I think everybody's pushing about, oil 2020-30, no more combustion engine, this. But the moment we get 2029, and there's not enough capacity to convert everything, I'm sure that everything will be shifted. Well, okay, 2030 probably is too early. Let's make it 2035 or 2040, So I think we'll be with oil for a kind of a long time. We can improve a lot. We have to improve a lot. But I think that oil will be with us for a long time,
Yeah, just going back to how we allocate the capital, it's a small comment. It's a big difference, of course, if you're a listed company or for Stena, which is 100% family-owned. The family was supporting our division 2019-20 when it was really, really tough times. And now it's time for our segment to pay back to the family. So of course we see the yard prices are very high now. Maybe it's not the right time to order at the moment. But then of course our owner, he has a lot of other projects he's looking at. And recently he bought a new oil rig. So it's different ways how you allocate the money if you're listed or privately owned.
Thank you, Ulf. And going over to the next question, which is actually kind of following up what we just talked about in terms of allocation. And I've always, personally seen, the years that we're going into now as a distinction between energy efficiency, which we would have done anyway, in order to gain a competitive advantage. But in terms of the decarbonization is something that is kind of posed upon us, which is good because it's much needed in order to comply with CO2 emissions. And in terms of that, how do you as ship owners evaluate the feasibility and profitability? And I'm sorry because it's a very, very difficult question. The feasibility and profitability of new designs, and I think Marco also mentioned this, like dual fuel vessels when technology is quite young and bunker availability and price remains somewhat uncertain and volatile. So how do you then strategize on that when you make those decisions?
Look, can I go first? Look, I'll tell you one thing. Honestly, I think that number one, I think there's different type of ships, and so, different courses for different horses. For example, you can't compare a VL who normally does a fixed route from the Middle East to US to an MR that does a lot of tramping all over the world. So, the fuel choices are very tied also to the type of the ship where the ship goes. Second question, I think that how do you decide what to? I think the technology is very modern, but I think also that there is a lot of things that can change. They can change the nature of the game. It's not only you do one thing and then you're 20% less in consumption or 20, because then at the end of the day, less consumption, less CO2 that's getting emitted. So there is very much tied up as a strict correlation. So it's not only the correlation on the consumption, but there's a lot of small things. For example, we found, and I know that in D'Amico also they're doing it, we spoke about it, they have some ships on the management, is for example siliconic paint. Siliconic paint has a great advantage for reducing friction because you have to do less hull. So a lot of small things, you save 3% here, 4% there, 1.5% there, and then you get the 15-20% so reduction. So I think it's just being careful, being informed, and acting proactively, and starting to try different solutions, because I think a lot of small things make a big difference.
Bart, do you want to follow up on that?
I mean, certainly agree with Marco, a really similar approach that we're taking at Ardmore. We have a dedicated energy transition team that is separate from the responsibilities of the day-to-day technical management, so that they can study and analyze the potential engine technology and vessels of the future, and at the same time use that knowledge to make the current fleet more efficient. And so, I mean, that group has reviewed more than 100 different hardware, software, changes to operating procedures, and we've made I think about a dozen different investments, first pilot testing and then for rollout across the fleet. And I think that's key, because there's the maybe initial stage of what you were talking about with the energy efficiency, but I think before we jump to the ship of the future, there's a lot more that we can do to the existing fleet that then will be put into the ship of the future as well.
And Ulf, I'll direct this next question to you. Since you're obviously also in the chemical space, and there's been a lot of unjustification on the CII when you're in regional trades with a lot of port calls. Do you see any specific threats or opportunities to the product tanker market from new regulations such as the CII and EEXI?
Well, I would say for Stena, we see more opportunities with it, but we have a fairly young fleet, so then it's maybe easier to say. I think we will see some of the older vessels disappear from the European market, which cannot really comply with the CII and so on. So that for us could be an opportunity. But what we heard before here from Frontline with ETS, we also believe that it will be the consumers in the end that will have to pay for it. It will be the European consumers and also the European industries will lose a little bit of competitiveness compared to other countries. But I guess some part of the world has to go first, I guess. But it would be better if it was a global initiative than just in Europe, is our opinion.
That is also that is also what one could believe, that there would be a global taxation at some point, and in combination with energy efficiency, because that is probably the only mean that you can do on a, say, total level until there is a sufficient fuel available, which would be totally carbon neutral. I will go on with the next question. I see that time is flying. So in terms of these strong demand and supply variables that we were talking about in the initial question, the first half of 2023 has seen orders for product tankers picking up, and in fact new ordering is 4 times higher in first half 23 compared to last year, and it has not been higher since the first half of year 2013. And this is obviously despite the high new building prices and the lingering around future-proof propulsion, as we just talked about. Are we set for the typical boom and bust when these ships are delivered? Will we see any overcapacity? What are your views on that, Carlos?
No, indeed, it is true that the order book has increased quite a bit this year. I mean, at the end of 22, cross product tankers, the order book to fleet ratio was at around 5%. Now we are around 9%. Most of the orders focus on the LR2 segment, which is a peculiar segment we are not present in, but it does, these vessels do trade quite actively from the clean space to the dirty space. So they should be looked at in conjunction also with the order book for the crude tankers. But nonetheless, it is a big increase. And on the positive side, it's also true that the fleet is aging fast. A lot of the vessels which were ordered in the last super cycle from 03 to 08 are now crossing the 15 and 20-year-old thresholds. So we already have today 35% of the fleet which is more than 15 years, and 9% which is more than 20 years.
Yeah, and just after that, I see that the product tanker order book now is 8.9%, which is, I think, decent. And you said vessels above 15 years and above 20 years, it's 10%, which is also quite substantial.
It's quite substantial, yeah. And it's actually going to increase further in the coming years. So according to our estimates, by the end of 24, we should have around 13% of the fleet, which is more than 20 years, and 53%, which is more than 15 years. So, so that helps, of course. But as long as the new building orders slow down, I mean, if they continue coming in at the same pace, then we might have a problem. We still don't have a problem. The outlook is still very good. This year, the fleet is growing very little, 2.1%. Next year, it's 1.2%. So it's a record low. It's a great outlook for next year. 25 starts accelerating a bit, but still manageable. But it's important that owners show restraint here, because I agree with Marco. It's true that we are going to have oil for a long time still, and I expect that the demand estimates by the main agencies, research agencies, are actually going to move forward. They are quite timid in their assumptions about demand growth after 26. And I think there's a good chance that it actually might be much faster, because, as Marco mentioned, renewable energy is a scarce resource, and there's a huge need for renewable energy, and there's a huge need for renewable energy for electricity in the first place. And then we are talking now about producing fuels with renewable energy for shipping, and that is a huge need also, which we are very far away from meeting. And so I think there are going to be bottlenecks that we are going to be meeting sometime soon in that space. which means that the old space is going to become more relevant for longer. So we could have some positive surprises on the demand side.
Very interesting, Carlos. Anyone wants to chip in on that?
I totally agree with what Carlos says, but only one thing, which is a demonstration of the age gap between Carlos and myself. He's still an optimist, and I'm becoming a cynical and a pessimist. He says self-restraint. Owners have been their worst enemies over and over and over again. And you go to a lot of owners, why did you order? Oh, because the price was good. Or why did you order? Oh, because if I wasn't doing it, somebody else was doing it. So as long as you have people with these schemes of mentality, it's impossible. You know, it's not let's hope self-restraint. You know, I don't count on self-restraint anymore. So the only thing you should count is that I hope they're building a lot of dry cargo ships. I think the container boom is continuing, so they build a lot of containers. So the tanker owners are squeezed out of the building, and so they can't build tankers, which is why we have a low building order. If you think about it, containers has occupied all the yards, then was dry cargo before. So we have been pushed out, but thank God we were pushed out. Otherwise we would have killed ourselves, you know, like me first, you know, like it happens constantly, you know, so, you know. So. But Carlos, it's good that you're still an optimist. It's good to be.
I agree with you, Mark.
It's idiotic, you know, and unfortunately, but I think that the market will reach a certain point of equilibrium, but cost is going up. For sure, cost is going up. There's no doubt about
Thank you,
that.
Marco, and thanks to Carlos for that insight. This was more, so let's say we conclude on a modest risk on the fleet. So if we move to the demand side in terms of risk, so my next question here, and we have 5 minutes left. So if China would suddenly reduce its product export quotas, it has been done before, either due to a very strong domestic demand or a clamp down on emissions. What would the impact be for trade? Are there any, refining hub there to replace those volumes that would then be reduced? We could start with Bart on this question.
Sure. Well, like I said, unfortunately, China recently announced its third batch of export quotas and stepped up, and it looks like exports will end up like kind of the order of magnitude 15% plus year over year. And I think the strong refinery margins will help as well, where even if the domestic demand in China is more modest, that they'll actually produce for export. And in general, whether it's China or newer refining capacity coming on in Asia and the Middle East, that tends to be a longer haul incremental ton mile benefit for our sector. So we actually, we actually think Chinese exports should be additive and might even surprise to the upside. And should that not occur, then other export centers in Asia likely fill the gap.
Thanks, Bart. Ulf, anything you want to add to that?
No. Okay.
And by that, I think, with 4 minutes left, we can open the floor to some questions. If anyone would like to ask these excellent panelists anything, now's your time. And if not, I have a couple of more questions. So, alternative to follow up on above, with OPEC and Russian crude production and export cuts, is it not inherent that China will reduce refinery throughput and availability of oil products for export markets, or would we just see draws on the stocks of crude? Carlos?
I don't think it's inevitable that they will reduce exports. And actually, if you look at the quotas that were provided this year for exports, with the latest batch approved of 12 million tons, we should be 2.7 million above last year. And there's still talk of an additional maybe a small quota being approved before the end of the year. Of course, there might be the occasional moment where there is a mismatch between new refinery capacity coming online in China and the growth in demand, and they might have to cut back, and they are definitely going to be managing export quotas actively as they have been over the last few years. But the longer, let's say, medium-term picture is that the refinery capacity that is coming online in China should be more than enough to meet the increase in demand and still leave some more for exports. So exports should grow over the medium term.
Thank you. And final question from me, if the audience is still without any questions, would be, and I think it's, inevitable.
Down there. Look, there is a gentleman who gave the question.
Sorry.
Somebody, a courageous...
Please.
Thank you. Tom Washington, S&P Global. My question is about the impact of Russia sanctions. With the oil price cap sort of being where it is and prices being where they are now, this would apply to obviously to dirty as well as to clean. That represents difficult questions to those who have been in a kind of in-betweeny kind of grey kind of fleet, who have been perfectly legally carrying Russian barrels using sort of under financial services. They now have to go somewhere else if they face difficulties over the price. That surely presents the prospect of more competition for you.
Sorry, the question is the grey fleet, the impact of the grey fleet, that's how it's going to be? The impact of the grey fleet, how's that going to be on... Okay. Carlos, you have any ideas? Look, it's a tough one, but look, a lot of the grey fleet goes back to the fundamentals. A lot of the grey fleet, if you talk to traders and a lot of people operating in business, once it has gone grey, is never coming back in the regular trade. So, and normally it's been that a lot of the older ships have gone in the grey fleet. But there's going to be a point where also if all of this mess and this turmoil, which I doubt will be in the short term, because I think sanctions for Russia, I'm sorry to say it, but I think will last a long time, because today they are sanctioned because there is a war, the war ends, there's going to be sanctions because they're going to be asked war reparation, and these guys are going to say no way war reparation. So I think it's going to be an ongoing process. But let's say that sanctions finish tomorrow. I think a lot of this fleet won't be reabsorbed. It's part of the older fleet, but there is still a core demand of energy transportation for countries that do not accept, that have accepted sanctions. So I think a lot of this fleet has been eliminated out of the market. It's the older part of the fleet, and so we go back, who's going to be building the future fleet? What kind of ships are you going to be building? What kind of technology? Because I think what's left is not going to come back inside this market, honestly. I see very difficult that traders and oil companies are going to reaccept using ships that have a kind of a tainted past, at least. That's my opinion,
Great question and a very good answer, Marco. And with that, our time is up. So I'd like to thank the panel for a very insightful discussion on the product tanker market. Thank you very much.